Okay, think just about everyone is in for today's session. So yeah, without further ado, I think we can start today's session. So hi everyone, my name is Don. Today we are going to talk a little bit more about US core PCE data, which will be released on Friday at the end of this week. And with that, a lot of people are looking towards core PCE data and seeing how it may influence a change or a move in the markets for gold and the US dollar, whether it could cause a big shift in those markets per se. So we're going to talk a little bit about that, talk about what core PCE actually is, and also with how we expect core PCE to move, how it would influence the gold and dollar markets. And then finally, we'll wrap up with a live analysis of how the chart is looking at for both gold, XAU USD, the ticker, as well as the US dollar index, which is the DXY. We'll take a look at both of that and then we'll see how it might shift given the release of inflation data. So just before we start on today's session, it's a quick disclaimer and a risk warning for you guys to read here. So I'm just going to leave it up on the screen for probably about 1 or 2 more minutes. So do understand that trading derivatives does carry significant risks. It's not suitable for all investors, and do understand the risk that you are taking on when you start trading with derivatives, which does include CFDs, contract for differences, which you might come across as a retail trader. I think that is extremely important for those that are rather new to the market. I always suggest, before starting with the before starting with your live trading journey, it's always good practice to sort of to look at paper trading and using that to sort of get better understanding of markets, be more familiarized with the trading platform that you use, or whichever broker you use, before you actually commit some of your own capital and put that actual money at risk, your own money, right? So yeah, I'll just leave that on the screen for about a minute or so before we start on today's session. Okay. Um, okay, I hope everyone has had a chance to read the disclaimer, and without further ado, I think we can start on today's session. So this is the agenda for today, pretty simple and straightforward. We're going to talk a little bit about what exactly is the core PCE index. We'll talk a bit about what are the market estimates and what it means in terms of how it would influence other things in the economy. Secondly, we will look at the outlook on gold and the US dollar, and specifically how this release of inflation data might influence gold and US dollar, and also some of the broader macro themes that are playing out in markets and might be might have a sway on both the gold and US dollar market and sort of uh, the broader market in a sense as well. And then finally, we'll take a look at the live markets for XAU USD and the XY for gold and the dollar. And we will take a look and see if there are any sort of setups, some of key levels that you might want to watch out for if you do trade these. If you do trade these tickers, some of the key levels you may want to watch, as well as sort of our idea of how the market may be moving for these tickers, right? All right, and of course, at the end of the session, we'll have a quick Q&A. But of course, along the way, if you have any questions, feel free to just drop them into the comments section and I'll be able to see them. And as we go along, I'll be able to address these questions, and then we can take them as we can go, or we can also do all of them at the end of the session. That lasts probably about 5 minutes of the session. We can take all the questions there. It's really up to you guys, right? So if you have any questions, feel free to drop it in the comment section now, or at the end of the session. I'll leave some time, hopefully, before we close off today's session. Okay, so let's dive right in, right? What is the core PCE index? So essentially, I think everyone's pretty in the know about CPI and the Consumer Price Index, which is a inflation measure and gives an idea of how inflation looks like in the market. Core PCE index is very similar to that. It is a measure of the prices paid by people for domestic purchases of goods and services. But the key thing that's different is that it excludes the prices of food and energy, which tends to be the much more volatile components of headline inflation that core PCE index essentially tries to strip out of. And that's also why without these sort of more volatile components, it is the Federal Reserve's and Fed's preferred measure of inflation. So this is actually the level that the Fed tends to focus a little bit more off. Of course, they do also focus on CPI and headline inflation instead. Adds back the value of price changes of food and energy, and that's exactly what is affecting people on a day-to-day basis or a regular basis. Essentially, when you are paying for food, paying for gas, you're effectively feeling the pains of that. But stripping away sort of the volatility of these prices, the Fed prefers to look at this for a deeper understanding of what are the deeper drivers of inflation, or essentially the stickier drivers of inflation that could be influencing the market. Those are the key levels that tells us a deeper story about inflation and perhaps what the Fed might want to focus on in terms of tackling inflation. Of course, their primary tool that they can use to tackle inflation is part of their dual mandate of keeping a low, stable inflation as well as high, low unemployment, high employment. Is still interest rates. And in the case of the Fed, it's the influence on the federal funds rate. But this gives them a deeper idea of, how is inflation moving, stripping away all the volatility in food and energy prices. And also, these are sort of prices that may not be entirely in the Fed's control. Energy prices can move very sharply due to geopolitical events, like we see that happening in terms of the oil crisis, in terms of Russian-Ukraine crisis, the volatility. It was very, very high in the crude oil markets, and that's not something that we can the Federal Reserve sort of can control in a sense. Even though it does, like I mentioned, affect people on a day-to-day basis. So all in all, this is sort of what a broad idea of what the core PCE index, and it's important for us because this is exactly what the Fed is looking out for, and having that eye on that is having that same focus for what the Fed looks like. It looks primarily at for inflation. So in terms of the past few numbers in the release that of core PCE data in April showed that it was at 2.6% year-on-year basis, which was down from 3% in February. So you can say that inflation is on its way down. It is sort of coming down to a level that the Fed deems to be a little bit closer towards the level they would like inflation to be, a little bit lower and more stable. And estimates for the April number that's due to be released at the end of this month is for a 2.5%, a further decrease in the core PCE index, which essentially what the idea behind it is that general market consensus that inflation is sort of under control, even though it might be slow in terms of how it's coming down, but it is coming down, and inflation is becoming a problem that is being decently managed. Of course, it would be good if the inflation numbers come down fast enough such that we are already within the zone of the 2% that the Fed would much prefer in terms of headline inflation. But at least there is progress in that sense, so that we can see inflation much closer towards the level the Fed deems to be much more stable, and that's when they will start to be able to have the sort of have a wider grip on interest rate. They can loosen it a little bit in terms of lowering interest rates and letting the monetary conditions be less tight and restrictive. That would be a benefit to the US economy. But of course, if they were to do that with lower interest rates, looser monetary policy, much more spending, that could also drive inflation back up again. And that's something that, of course, after many quarters and many cycles of interest rate decisions where they've effectively kept monetary policy restrictive enough, they don't want a resurgence of inflation and the same problem coming back again as well, especially given how uncertain and how volatile trade policy and other components of the US economy has been. Right. So if you look at inflation, it's a bigger picture, right? Inflation is still the key part of the Fed's dual mandate in terms of, like I mentioned earlier, low stable inflation as well as low unemployment. Right now, it seems like the Fed's still taking a wait and see approach, right? The federal funds rate was held constant in the latest Fed meeting between 4.25 to 4.5%. So effectively, they've not done anything to lower interest rates and to put the country on a path to lower rates faster, right? And the key idea behind it is to see, are interest rates sufficiently restrictive, but not still a chokehold on growth, or are they too restrictive and actually hindering US economic growth? I think more than that, also more than just looking at inflation. Of course, yes, inflation is coming down, and sort of theoretically, as inflation comes down, it could be a sign for that the Fed does have a little bit more of a leeway to lower interest rates and of course let the economy rebound. But I think in today's market, it's definitely more important to also look at other factors that might be driving inflation in the coming few years, right? So first thing definitely is US government spending in terms of the fiscal deficit. We have the release of the Big Beautiful Bill in terms of the Trump administration's idea of how much they want to spend in the next few years. It could definitely, in a broad sense, is deemed to be inflationary in nature. It's expanding the fiscal deficit from the US. Also, could have possibly contributed to an undermining of US government credit. So a downgrade in US government credit rating last week. So that is definitely one thing that the Fed is keeping an eye on, and also trying to make sure that that it doesn't become a big driver of inflation going forward, and resurgence of their own problem again, right? So it's not just looking how inflation has been in the last 2 months. That tells one side of the story, but as trade policy develops, as Trump administration's policies continue to be released and develops, those are things that are a little bit more forward-looking that definitely the Fed is definitely taking into account in terms of whether they want to move interest rates in a certain way or not. And I think that's probably contributing to why the Fed is keeping more of a wait and see approach to see, is inflation moving in the right way, and looking forward, can inflation move in the same direction? Okay, so talk a little bit about the core PCE index. So I'll talk a bit about gold, right? So gold definitely still driven by supply and demand dynamics. There's still demand from central banks as a store of value versus the USD. I think this idea of gold being a safe haven demand from geopolitical risk previously has been thought of already. When there's a lot of political conflict, volatile trade policy, stuff like that. In times are uncertain, gold definitely benefits from safe haven demand. But I think even more so right now, it's seen as a safe haven and as an alternative from the USD by central banks to be seen as. Previously, the US dollar was thought to be also a safe haven, but right now, much less so given the loss of confidence, or perhaps not loss of confidence, but erosion of confidence in the US economy, in the US political system, and given how volatile policy has been, people are sort of shying away from the US dollar a bit, right? And that's when they tend to look at other alternatives for a safe haven. And the first thing that you might look to is shiny metal, right? So, but definitely, I think monetary policy continues to drive changes. But you want to continue looking at the supply and demand dynamics. Right now, I would say the demand for gold is strong, but it's sort of stretched, right? Gold is reaching very high levels, all-time highs even, and it's sort of taking a little bit of a breather right now. It of course remains to be seen whether the demand can be pushed further, or at eventual point in time the demand will start to taper off a bit. Right, so we'll take a look at gold later. We'll talk a little bit about US dollar. Like I mentioned earlier, there's a release that sort of waning demand, the idea of the end of US exceptionalism, which I think is a trait that has been playing out over the past few weeks and months, perhaps coming a little bit to the tail end of this theme playing out, given that the idea and essentially what's the idea behind it is people moving away from US assets, whether it be US stocks, US bonds. People are sort of shying away from that given how volatile the current administration is. So you see sort of earlier in the year, prior to April, sell-off in US stocks, rise in US bond yields, and lower demand for US treasuries, for example, which we still see right now. And as treasuries continue to hold, treasury yields continue to hold very high rates. The US 10-year is close to 4.6%. So I think that is a theme that's played out, sort of playing out right now. But that idea of, tax cuts, tariffs, US exceptionalism coming to an end is sort of sapping away the US dollar's demand, right? Not helped by inflationary policies with very uncertain ways of how it's going to boost growth, right? So there are also bigger concerns we're looking at, the fiscal deficit and undermining government credit, which is sort of pushing demand away from the US, and investors are looking at other markets, right? For example, European markets or Asian markets, where they're sort of seen as alternatives to the US dollar even. So one dynamic to look at is other safe haven currencies, for example, like traditionally seen like the Swiss franc or the Japanese yen. Those have sort of benefited against the back of a weakening US dollar. So we'll take a look at the DXY as well, see that how that has sort of played out. Okay. And with that, we will move on to our trade setups for today, which is for gold and US dollar. Before I move on, I'm going to just pause for a little bit, see if there's any real questions in our comment section. Okay, I don't see any yet. Right, no worries. Whenever you have any questions, feel free to just drop them to the comment section. I'll be able to see them and we can address them there. Okay. But now let's move on to our charts for today. Okay, so this is the chart on gold. So I'll just remove all these indicators. So these are sort of my markups for where gold is looking at. So just for this, I'm just going to move to another chart. Okay. So generally for gold, I'm just using the daily over here. But yeah, I'm just going to use the daily to show you guys a little bit of the price action on gold and how that theme that I presented earlier, a bullish narrative for gold, is sort of playing out. So you can see that from the start of 2025, gold has been seeing a very, very strong push towards the upside right now. It seems like gold is taking a little bit of a breather after pushing to the all-time highs near the 3,500 level near the end of April. Now it's sort of retracing a little bit and taking a little bit of a breather. But all in all, just in terms of technicals alone, it would appear that gold still looks to be very much in a bullish environment. You can draw a trend line and you can see that essentially gold is still pushing towards the upside, even counting for the deeper retracement right now. Some of the key levels that we probably want to continue looking at is definitely this 3450 level, which is the previous high that has been tested by gold. Okay, I'll probably say around the 3430 which was tested not once but twice in terms of the reaction for gold. So any push towards the upside above these level, 34.30 level, it definitely means that gold is going to be creating higher highs from here and continuing that bullish momentum. But any break below this ascending trend line and probably below this support level, the swing low support here, near the 31.70 level, that will probably indicate that gold is possibly going to take a deeper retracement than previously thought. But this level of support, I think, is pretty important support. It was tested as resistance here, and when gold finally break above in April, now it's coming back to test as a support level. So this is a pullback support that I think is pretty key, also in line with that ascending trend line over there. So once price comes quite close to around these levels, 3,200, 3,170, I think it's important to watch out for the levels here. And a break and close above that 34.30 level, I think will be quite key for gold in terms of creating new all-time highs and continuing that bullish momentum. You can also take a look at Ichimoku cloud, which is indicator that gold is coming quite close to the cloud, might act as a sort of support there, but the fact that price is holding above the Ichimoku cloud does show that it's still looking to be more of in bullish territory right there. Okay. But of course, if price retraces much more than we expected below the 31.70 levels, then we have to look at other support zones that probably gold would be testing deeper retracement than possible. And then that's probably where we want to take a look again at the supply and demand dynamics, whether that strong demand from institutional players is still in play, or are we looking at a different narrative going forward? Okay. I'm conscious of the time, so we'll take a look at the DXY. So DXY looks like it's basically in a reverse, right? So these are my markups from previous time. We can see that DXY is holding below that second trend line. I'm just going to pull up a chart that's clean. Yeah, you can see very similar idea here. DXY is still looking to be in very bearish territory, which is in line with essentially what the macro environment tells us in terms of where the DXY is headed towards lower demand. Not many people buying US assets, which is why there's sort of sell-off since the start of the year, and with these of other policies that sort of question the trajectory of the US economy going forward. Right, so in terms of key levels, the resistances you want to look out for, definitely the 101.3 level. I think that's a key level that you want to look out for. Then beyond that, that will be probably above this descending trend line resistance, and that's when probably a deeper throwback, the deeper pullback in terms of prices would be something you want to look out for. The 104 level, probably somewhere that's 104.2. The next sort of resistance that you want to look at in terms of support levels, and a continuation of that bullish trend, I would probably look at this 97 or around 98 level. So you see a break below this level and convincing break and close below this level, and probably the price would probably want to test for the support levels below that. So as price sort of retrace a little bit, you can see probably the 101.3 level closer to the descending trendline resistance. That would be somewhere interesting for you. If you look at sort of EMA, so I like to take a look at EMA at times to see how the trend is playing out. And typically, I like to look at maybe a 50 EMA as something that's a little bit more long term. And why I sort of use EMA is it gives a little bit more weight to the time periods that are closer to us. And I think much more important in the current scenario where more recent data and more recent price action may be more relevant to us as opposed to later price action, given how difficult it is to predict trade policies, and how tough it is to take a look at how tough it is to predict policies that are probably released like a week or two before us. Those are things that probably would influence price a lot and things that people may not be able to project as far out as what we were able to do in a previous political system, at a previous administration, for example. So that's why I tend to look a little bit more at EMA right now. And you can see the 101.3 level is also close to the EMA, which is probably that level in line with the swing high, in line with the descending trend line resistance, and maybe in line with that moving average. That's a key level I want to watch out for. And then a break and close before below the 98 level. I think that's probably where you will see further downside and further sell off of the US dollar. Okay. All right. With that, we come to the end of the live analysis session. So before I close off the session, I still have about 2 minutes. If you have any questions, feel free to drop them in the comment section and we can discuss it there. Nope. Okay, I don't see any questions. Yeah, thanks. In that case, thanks everyone. Really appreciate your support on this evening. Of course, if you have any questions that you might have about what I've covered today, you can see the QR code that is on your screen right now. You can do have a question on what time frame should I trade on. Okay, so I think that really depends on your style as a trader, right? If you're are you looking at more of a day trading style, or you're looking at taking position trading style that's a little bit more long term, or even if you're more of a scalper, you look on very low time frames where there's a lot of movements, and you will just want to scalp a tiny movements, a few pips in price, then that really is dependent upon you as a trader, right? Whether you can afford the time to be scalping, whether you can only afford a few minutes a day and you only take longer positions, and that will sort of determine the time frame that you'll be trading on. And if you're day trading, you would look at more on the hourly time frame. So perhaps the 4 hour or the 1 hour. I would try to move a little. If you're just day trading and not scalping, I would try to not go on too low of a time frame, because that's where you see a lot more noise. And that may sort of complicate things. But regardless of what time frame you're trading on, I always sort of would say that you might want to look at multi-time frame analysis. So that's when you look at the higher time frames, you build a view from there, and then you scale it back down towards a lower time frame, which and look for setups that support that higher time frame view and the macro analysis that you have of the general environment. I think that's sort of a sound way, I would say, to apply multi-time frame analysis. Okay. So yeah, with that, we've run out of time, actually run down the clock. So I will say thanks everyone for joining me on today's session. If you have any questions, any feedback for the session, you can enter your feedback by scanning the QR code that's on your screen right now. I'll be able to see it, and the Vantage team will be able to see it, and they'll be able to forward it to us, and we can probably talk about it in the next session. So with that, thank you everyone. I hope this was helpful, and I'll catch you in the next session.